Welcome to IVoT Eye on Investing, a discussion of the markets and investing from a long-term fundamental perspective, hosted weekly by IVoT Academy. To learn more about IVoT Academy, hit the link in the description. I am Ed Butowsky, managing partner of Chapwood Investments, and I'm joined by market analyst Andrew Tang, chief investment officer of Turner Investments, and IVoT investment analyst Emile Westergaard, CFA, founder and CEO of IVoT Financial Training. So it's really nice to have you two esteemed IVoT experts and to do the market analysis, Andrew, and for you to do the investment analysis, Emile, which we're going to dive into on Tesla today. Welcome, Andrew, and welcome, Emile.
Thanks for having me.
Thanks, Ed.
Well, you guys do a spectacular job in analyzing things, and I want more people to watch this show. So anybody watching it now, feel free to share it with anybody because you're going to get a lot of information out of this. Andrew, why don't you take us through what's taken place in the past week or so?
Yeah, I'll just give the audience an update on tariffs and the situation. So basically, the Trump tariffs, including a 10% baseline on all imports and 25% on vehicles and auto parts. The only country right now that is not responding or have this continuation standoff is China. Outside of that, I believe most of the countries are beginning to negotiate with the White House, and that's a sign of improvement from the Rose Garden event. So the recession fear, as reported by Recession Alert, as a research firm, for U.S. falling into recession in the next 3 to 4 months have actually jumped from 25% to 75% right now. And so with the Trump tariffs, as a major reason, there's still a lot of uncertainty out there, and that really goes to show, especially with CEOs, they're coming out with earnings and they're beating earnings for the most part, but they're not giving guidance, right? And this China trade standoff would most likely end soon. This is from what we see, because if you take a look at the pros and the cons are so bad that it could be a repeat of a mini version of the 2020 global shutdown. We already have China factories, basically standing idle. We have containers not leaving the port, and the port of California, I believe it's reportedly to expect to have a drop of anywhere from 34 to 35%, somewhere around there. So the international negotiation, it's good. It's good for the progress. But at the end of the day, the biggest overhang is China not positively responding.
So, Andrew, you talked about the possibility of a recession going from 25 to 75%. Are you using the definition of a recession or a newfound definition that a lot of people like to use?
Yeah, for the organization that officially name it a recession or not really depends on if we're going to get unemployment data at elevated levels or not. Now, the previous 2 negative or consecutive quarters of negative GDP, we still didn't call that officially a recession because the jobs data was still strong. And so this is what we believe, that Jay Powell and the Fed is really closely monitoring the economic data and the jobs numbers. So if the unemployment number continues to climb higher, then yes, the risk of recession is going to be more pronounced. Right now, the 75%, it is an aggregate of economic activities that contribute to recession. So similar to the Conference Board's leading economic indicator index. But again, the only offsetting piece right now is unemployment data that is still not showing too terribly weak right now.
Okay.
Yeah. So if you take a look at how the market responded, right? So you look at the S&P 500 market high 6,100 all the way to the 4,900 drop that we have had. So from the low point to high point, we're exactly right in the middle. We're at 5,500. So the volatility is really here to stay until we have some positive news coming out of China and the US. The tech sector has been hit really hard. Earnings been out for Q1 for the most part. Believe it or not, 74% of the companies have beat expectations with the projection of earnings growth somewhere around 9.7%. Now, is that going to be real? Again, we're reporting what has been, right? So going forward, we're seeing more and more CEOs just listen, we cannot give guidance because we don't know how tariffs is going to affect the next quarter's earnings. So we're finding more and more companies just not giving guidance. So we're not going to have as much clarity as we want for future earnings. And so far, the sentiment of the U.S. and China trade really have bled into the polls of grading how the president is doing, for the first 100 days. And so far, his approval rating is hanging somewhere around 34%. Um, it's great that the Federal Reserve's Jay Powell's job is not in jeopardy. That really calms the market. But we really have to see if the next shoe is going to drop or not, and that is the labor market. If unemployment numbers starts to continuously climb higher, I wouldn't be surprised that the Federal Reserve might come in and start to restart the lowering rates in June by 25 basis points.
So when you say 9.7% earnings growth projected, then if the PE on the stock market is 20, that means the PE should equal the growth rate. So that means the market is still very expensive.
Yeah, in parts, you can look at it that way. I mean, right now, of course, if you look at the Magnificent Seven, they have been brought down to lower levels, but because of these tech giants' weight is so heavy on the S&P 500, the PE, it's going to be skewed to the higher, to the upside. There's no doubt about it. But if you take out the Magnificent Seven, if you look at the S&P, the rest of the constituents, I call that, 497, 493 or so, their PE ratio is actually quite reasonable. And several months ago, if we look at the PE of the rest of the S&P 500, they were as low as 15 and a half. And so, right now with, this big dark cloud of uncertainty that is still overhanging Wall Street, I don't expect, the PE to climb or continue to climb anytime soon until we get more clarity.
So Emile, you made an expression when I said that your PE should equal the growth rate. Do you not agree with that?
No, well, look, there are different ways to approach what we call fundamental investing and how you value the market or, for that matter, a specific company. And it's really the same thing. The market is an aggregate of cash flow. And to your point, you value that cash flow on a multiple. And the question is, what's the appropriate multiple? Same thing for a company. And we'll look at Tesla and we'll talk about what's the appropriate multiple for a company. At IVoT, and this gets into our specific approach, we actually use a fixed multiple for everything. And that's something you'd learn when you join our platform, which is actually 25. So we have a higher multiple than that for valuing what we would call a perpetuity, right? Because when you own the index or you own the market, you literally own it forever. It's not something that's going to be taken away from you. And again, how we justify that, how that works, is something you can learn when you join the platform. But we don't use PEs. We really focus on measuring cash flow and using a multiple of present and future cash flow. So first thing is, what's the current cash flow of the market? What's the multiple? If it's 20 times, which is roughly a cash flow number because we don't have cash flow for the market, then I think there is actually a little room for upside if the future is good. The thing is, the market is forecasting the future, right? So if it's below 25, what the market's really saying is the market's uncertain about the future. To me, 25 is par. If it's trading at 20, it means the market's saying, well, I think future cash flow or future profits may decline, which is kind of what we're getting at, right? Is the economy stable? Is all of this going to mess up the global economy? And that's the conversation we want to have. That's the one we're having right here. That's fundamental. That's not, oh, is it 22 or 23 or 25? Is cash flow going to grow in the future or not for the S&P 500 or in a couple of minutes for Tesla?
Okay, so Andrew, why don't you finish up and then we'll get to Emile and he can go through the IVoT forecaster with Tesla.
Yeah, with echoing what Emile was saying, I always look at the stock market as the aggregate marketplace of present value of futures earnings or futures cash flow. And uniquely for 2025, I think it's more about a combination of cost savings as well as growing your top line revenue, especially with the aid of AI and with the maturity of AI coming to place, having it applicable to be in AI agents and software. So for companies that can save money, that's basically adding the bottom line, to the bottom line. And then, the current stock market is a very accurate of an aggregate, snapshot of present values of futures earnings and futures cash flow. So
And just to
continuing,
add one thing, sorry, just,
yeah,
because Andrew's
sure.
been talking about this a lot in the prior weeks. We're going through a transformational period in business overall with AI. So, the cost structure of the global corporate industry is going to change in the next couple of years. We're only in the beginning of that. And so this also adds a huge, very interesting component to trying to predict future cash flow.
Yeah, absolutely. Yeah, even business activities, we're seeing manufacturing activities at all-time low right now. And I don't disagree with that, and I absolutely agree with the data because right now we're in the process of trying to reshift this global supply chain. And again, it's going to take a long time, much longer than 90 days, for sure. And so now, we're seeing Trump are easing and backing off, with the 25% tariff on automobiles and car parts. That's good news. That's basically coming to reality to understand that, it's going to take a lot more time for, the shifts to happen. The public sentiment is still not very good. Again, with the 100 days review of the president coming up, uh, his approval rating is, according to the polls, and again, I don't know how accurate these are, but somewhere around 37% Americans are approving of his policies. And we're starting to see more and more, a non-transparency. Again, the CEOs are not giving out guidance. And, so far, this is where we are right now. But if you look at the volatility index, the VIX, we're not at the 30s anymore. In the 30s, that's crisis mode. Above 20, it's still a scare. It's still a unit measure of showing concern. So the market it's perplexed, obviously, but right now it seems like we're at the midpoint. So we are doing much better than the crisis mode. But still, we have quite a bit of clarity to go through and for corporations to go from there.
So the other day I was asked to go on a TV show and talk about Tesla. And afterwards, one of my clients called me and said, "You obviously don't know anything about Tesla." And I said, "Well, I only got questioned about it. I got notification about 10 minutes before I went on. So no, I don't know a lot about Tesla." So Emile, can you take us through the IVoT forecaster and tell us about Tesla and where it's valued?
Yeah, sure. I just real quick, I'm just going to, for 1 second, just show everyone the platform where you can come and use the tools that I'm about to use. This is our training center. This is our community center where you can get our expertise. And this is the tool. So that was a fast move through it. Sorry, everyone. But this is the IVoT forecaster for Tesla. And, there's two ways to talk about this, Ed. Someone can come to you and say, you don't know a lot about Tesla. I know Andrew has spent a lot of time, more than me, studying Tesla, so he'll have his 2 cents to put in a little bit. But from an IVoT perspective, I don't care if it's Tesla or Disney or Exxon, what you own when you own a share of the company is a share of their cash flow stream. And so the question is, what's that cash flow stream worth right now? And that's called the intrinsic value as opposed to the market price. We can see right now Tesla shares are trading at 280 bucks a share. Okay, the market cap's almost $1 trillion. The most recent cash flow, on the other hand, declined 25% from a year ago to 1.6 billion, which, according to the intrinsic value calculation, values an estimated Tesla shares are estimated value at $55 a share. So you're paying $281 for a cash flow stream that's worth $55. So that obviously is extremely expensive and means you have to believe from an IVoT fundamental perspective that Tesla's cash flow is going to grow gangbusters over the next 3 years. Because, we say that you're owning the future and we can do a reasonable forecast on Tesla 3 years out if we do the research. And again, you come to our site, we'll help you do the research. You come up with your own forecast of what's going to happen to car sales and battery sales and all this stuff. But let's just say here, first of all, that it's down from $69 a year ago. The peak cash flow value of Tesla goes back to mid-2023 when it was worth about 170 bucks a share on cash flow. So it's been degrading for the last, now almost 2 years, the business. And so the question is, what's going to happen next? Now, you all probably saw this. I think last week when we did Starbucks, I said Brian Nichols is the $40 billion man because the stock went up 40 billion when he was hired. Well, when Elon said last week that he was going to lay off of Doge and come back to Tesla full time, the value of Tesla went up a freaking $80 billion. So you could call him the $80 billion man. He's a Marvel comic character, right? I mean, it's out of control. So the question is, what needs to happen to Tesla to get the value to something even close to where it is now, forget with a return involved? Now, again, cash flow is very simple. You either grow sales, meaning he's got to sell more cars, or he cuts costs. Now, if we go down below, we can see in the most recent quarter, his sales declined by 9%. That's a big problem. So the business in the most recent quarter was terrible. And his costs went up by 110 basis points. So he's seeing bad news on both fronts in the most recent quarter. What would it take to increase cash flow up to get this in 3 years? Again, this is compounded. Let's just say he magically gets sales to grow at 30% again. Car sales, batteries, whatever it is. Well, that only gets us to 69 bucks. Now, if he gets the cost, I can tell you that his cost of goods sold has been as low as 65%. That was a couple of years ago when he was really jamming stuff through his factories. If he can get this down to 70% over the next 3 years, let's say, that has a big lever in here. That gets you almost to 200 bucks. That kind of gets you into at least shouting range of where the shares are trading. Now, again, I'm going to stop there because that's really enough, right? I mean, we can now discuss, Andrew, with your perspective. Do you think he can turn this thing around in the auto business? I know he's got two businesses, right? Just to finish here. He sells the cars and he sells the batteries. Now, the batteries have been doing well. It's true, but they're only a $15 cash flow business right now. They're not worth a lot. They're still really nascent. So if you look at it, he's got to really juice the car business and get those factories back into full production mode to get his costs down. So let me stop there and let's just talk about it. And again, if you want access to these tools, join IVoT Academy from the QR code.
Yeah, these are great talking points there, and I really appreciate the breakdown of the analytical work that you have. But I think there are a couple of things going on. Obviously with the new introduction of Juniper, the new Model Y, what you're reporting, it's already backwards. These are all expected. Lower sales number in Q1 is reflecting of the change of the best-selling vehicle out there. So we expect the sales number to start to pick up again with the Juniper, with the Model Y. And, it's very likely that it's going to be the best-selling vehicle country by country, region by region. And moreover, we're starting to see Wall Street is currently accepting the understanding of how Tesla is transitioning from a car company, a standalone car company, to an AI powerhouse. Okay, so we always talk about present value. So with all the accomplishment and all the execution that Tesla has done so far, you can say, okay, let's count beans and let's count cars, looking at Q1 numbers, and we can isolate that. Absolutely. They do have megapack facilities, that is generating a lot higher, operating revenue. 15% from making cars is already very good. But if you're talking about megapack, they're, jumping up to 20 to 25%. Now, if you talk about robo-taxis, where we are entering into the realm of software as a service, this is going to command anywhere from 60 to 65% net revenue. So these are very important factors to observe. And also, yeah, we are looking at, hey, the revenue is not here yet. Waymo is making X dollar amount, Tesla zero. You can make that negative argument all day long. But if you look at the accomplishments and compared to where they are in terms of the timeline, yeah, June, Robotaxi is going to launch in Austin. That's for sure. A lower price model is going to be introduced. Juniper, I believe, is continue to sell well throughout the world. And, on top of all this, Tesla has access to the most powerful AI. It probably, bar none, if not the best in the world, is definitely top 5. All that, how much is that worth? And then beyond all that, you're going to see Optimus. The robot's going to start, mass producing, for commercial use starting 2026. And so all these RAM, all these scales, and then on top of all this, the Tesla Semi is coming online soon. And so when that really gets going, I'll bet you that it's going to be it's going to be more than just Tesla selling semis. They most likely is going to create a logistic platform similar to what they're going to do to robotaxis. So to put the present value for all these amazing ventures that's out there, that's why Wall Street is agreeing, and they're starting to show the world that yes, Tesla is transforming from a car company into an AI powerhouse. So that's what
how much money can they make doing these other services, these robots and the automated cars?
Yeah, you really have to look at, how large is the market for the rideshare markets, right? And how much disruption is that going to basically place on Uber and Lyft and the similar businesses out there. And these are multi-trillion markets out there. And, we're not even expecting Tesla to become, the winner takes all. This is winner takes most. And right now, Tesla is just getting their foot into the door. And I think this is, this will be, again, 2025 and 2026. These are going to be the 2 most important years for the company. And again, just want to reiterate that, these are not investment advice. We're just doing a deep dive into the company.
Well, and I think, Ed, maybe to your point, first of all, I'm going to call Andrew the Tesla bull for sure. Okay.
Oh, for sure.
And in the end, Ed, I think you're asking the right question, which is what we want you to learn how to do at IVoT, which is actually how to not just say, oh, I think, robo-taxis are coming, but what's the actual cash flow value of that business in the future to Tesla? Let's call the robo-taxi. Well, the question is, first of all, to Andrew's point, how big a market is that? Also, what's their competitive positioning vis-a-vis the other companies that are in that market? Do they really have an edge? Do they have an edge in AI? Do they same thing? Even talking about the new the new model car, if you go into our tool, you can actually forecast how many sedans are they going to sell in the next 3 years, and what does that mean for the cash flow value of the company? Those are all embedded in the IVoT Forecaster for Tesla that you can use level 2. We have a level 1, level 2 tool, so it's really cool stuff and really gives you a way to create your own value for the company as compared to the market, which, a couple of months ago was trading at 500, then it was trading at 200, now it's trading. I don't think, honestly, Andrew, that the market has a view on Tesla. The market is a schizophrenic freak around this stock, depending on what the news flow is. I think you're giving it too much credibility as far as a fundamental view right now. I think it's just kind of a hype machine, honestly. But That being said, we can at IVoT sit down and run the numbers and do a forecast with the tool and come up with a real solid idea of what we think it's worth.
Right.
Okay, well, this has been a great discussion. I want everybody who's watching this to share it with somebody and like it and follow us, because this show is going to continue to grow and we want you to be here at the onset of it. So Andrew and Emile, thank you very, very much for doing this today. And we look forward to doing this again next week.
Thanks for having me again.